Yes, thank you very much. Welcome everybody to our panel. This is a policy panel on support policies for households and firms. I am Roberto Chang, professor of economics at Rutgers University. And I want to start by thanking the Central Bank of Chile, especially Governor Marcel and Andres Fernandez, for the opportunity to host this panel and this very distinguished group of colleagues and experts, and I'm looking forward to the discussion. Let me just quickly introduce our speakers. The first one will need no introduction, but I am going to mention some important parts of his trajectory. Professor Robert Hall is the Robert and Carol McNeil Hoover Senior Fellow and Professor of Economics at Stanford University. And as I said, he has made path-breaking contributions to a number of issues in applied macroeconomics. I think that all of us actually grew up or have studied his important work on consumption, marginal costs, taxation, productivity, and so on. Everything that we talked about in macroeconomics, I think that Robert Hall has contributed to, and his list of honors and accomplishments is just too long to repeat here. Let me just highlight a couple of important parts. He has been, he's a distinguished fellow of the American Economic Association, president of the American Economic Association in 2010, fellow of the Economic Society. He was director of the National Bureau of Economic Research program on economic fluctuations and growth from 1977 to 2013. And very importantly, if you care about recessions, he acts as the chairman of the Bureau's Committee in Business Cycle Dating. So if you worry about recessions and expansions, then he is the person to convince not to happen. But in any case, welcome, Professor Hall. Then the next speaker will be Augusto de la Torre. He's now a professor of economic policy management at Columbia University, and also the director of the Economics Research Center at the Universidad de las Américas in Ecuador. Also, he's a non-resident senior fellow at the Brookings Institution, as he's well known in Latin America because he was, until very recently, the World Bank's chief economist for Latin America and the Caribbean, having been before that the president of the Central Bank of Ecuador. The third speaker will be Norman Loayza, my co-author and friend, and he's just starting as the new director of the Global Indicators Group at the World Bank. Congratulations on that appointment. He's just leaving the post of lead economist in the Development Research Group and the manager of the Asia Hub of the research group based in Malaysia. He's well known, especially to the Central Bank of Chile, where he spent some time as a senior economist on leave from the World Bank. And the fourth speaker will be Elías Albagli, who is now director of the Central Bank of Chile's Monetary Policy Division. Also, he was the director of the Research Division and manager of modeling and economic analysis of the bank. He has been an economist at the Central Bank for some time before he was an assistant professor of economics and finance at the University of Southern California. So we are looking forward to the discussion. The format is going to be, we're going to have two rounds. For each participant will have the opportunity to comment on two sets of questions. One is what kinds of policies have worked in this pandemic situation. And the second set of questions was related to the question of what we can do, we should do moving forward. So this is the agenda, and without further ado, I will pass the microphone to Professor Hall. Welcome, Professor Hall.
Okay, I'm gonna. Okay, so I'm going to talk about American policy. I'm not sure I'm going to quite rise to the occasion of telling you whether it worked or not, or in particular whether it was optimal. But let me take a stab at it. So economic policy with respect, I should say, first of all, I've been following, but I'm not an authority on the pandemic itself. So of course, policy, the central aspects of policy have in the U.S. have been focused on trying to control the pandemic with relatively poor success by international standards. But I don't have expertise in that area, so I'll just take that part of it as given. The economic policy in the U.S. was very single-mindedly focused on what I would call cash flow replacement. That is trying to identify individuals such as those on recall or otherwise unemployed. It was a major subject. People in general who received one-time $1,000 cash grant is another. So there are grants to different parts of the economy, small businesses, large businesses, airlines. A great many claimants went to Washington and got cash grants. In addition, there were numerous programs that either were characterized directly as loans or which in effect were loans, such as forbearance. And there was a lot of that. All these contributed to making household and business operating statements better, in some cases a lot better than it would be without the policy. So as I say, it was a cash flow replacement policy. The grants were so generous that it resulted in a huge increase in disposable income, as you can see in this slide. $2 trillion of increase. So the theory behind the cash grant policy was to try to make up for deficiencies in cash flow to households and businesses. The result from the perspective of households was an unprecedented increase. So not only was the hole filled in, but it was way more than filled in initially. Now these numbers are at trillions of dollars in annualized. So the total amount of cash wasn't quite that large, but it was at least $1 trillion in an economy that has a GDP of 20 trillion. So it's a non-trivial contribution. So basically policy made households as a group awash in cash. Now, the motivation for this, I believe, was to try to reach
Professor Hall, I'm very sorry to interrupt you, but we're not seeing your slides.
Oh, no. Shoot, what? Okay, thank you. Thank you for interrupting me. That's essential. All right, well, we have to go back to square one. So I did everything that I was supposed to, but I'll do it again. So share. Does the share button work? It seems to work. Did it?
We're not seeing any shared content yet.
Well,
Do you want me
well,
to pass the slides for you?
okay, I'd have to email you the slides.
Yes, you emailed me. Just give me a minute and I will upload them.
That's only, well, this is, what's wrong? Why? I did everything I'm supposed to. I pushed the share button and nothing happens, apparently. Even though the problem before was that the share button wasn't, it's not grayed out though. I think I should just proceed and I can just describe them. The slides aren't really essential.
There we go.
Okay, is that being shared by me or by Sophia?
I think that Sophia is doing it.
Okay.
Yeah, I'm the one doing it. So if you can tell me when to move on.
Oh, fine, sure. Oh, okay, so you were able to. Well, that's okay. You've created a miracle. I don't know how you did that, but that's fine. That'll be perfectly fine. But so, well, now it's obscured by. Okay. All right. Anyway, all right. So the philosophy behind this huge injection of cash into businesses and households was, I believe, intentional to try to reach some hard to reach families who were seriously affected. We know, for example, that the loss of income was greatest among the relatively young, relatively unskilled workers who were employed in restaurants, which were the single biggest loser from the pandemic. But still, you would never guess from coverage that emphasizes people who were not reached in spite of this ocean of cash being thrown at the household in general. Obviously, one thing which has not really been done yet, but I'm sure will be done, is a much more detailed analysis of where the cash went relative to where it needed to go. But the sheer amount of cash that was available surely could have solved that problem. I guess if it had been done with better information and more of a philosophy of targeting the most needy households. As a result of this, in spite of throwing $2 trillion of cash into the, which plus whatever was actually necessary, was pretty astonishing. Okay, so now let's look at the next slide, if we could. Great, excellent. So what happened to consumption? Consumption just plummeted at the very same time that everyone is being protected, or at least in not everybody, but on the whole, an awful lot of cash was being injected. So the idea that that the U.S. economy is governed by households that have their backs to the wall and are simply mechanically spend all the income they have was, if it hadn't previously been refuted by the efforts of many economists, including me, it was just remarkably confirmed. So consumption declined in spite of the extra $2 trillion of spending power in the economy, because many types of categories of consumption, like restaurants and travel, were blocked. And people said, well, if I can't do that, I'll just save the money. So there was just a huge increase. So there's $2 trillion, about the same amount. So there was a $4 trillion at annual rates swing of extra saving. Now, this is really important. In particular, it reads on the question of whether giving people loans has any constructive value. Loan programs turned out to be not very popular compared to the cash grant programs, which were immensely popular, needless to say. Well, it just reflects what the economics we're seeing here. If generally speaking, households were saying, I don't need more cash because I'm really cutting my consumption because the things I want to consume aren't available. Then offering them loans does no help at all. It's just not the right thing to do. So I'd say that the attempt to deal with cash constrained households by giving the household sector as a whole access to loans, I would think primarily through forbearance. Forbearance has been very little used. It's just a remarkable fact, even though it seemed like an obvious move for lots of people, but the numbers show that it's just been almost everybody who's a renter, for example, even though they have the right to discontinue the rent, have continued to pay rent quite remarkably. Well, you can see that in the setup. You might as well, if you're doing all the saving, you might as well save partly by paying your rent, and that's what the household sector as a group did. Now, of course, again, there are impoverished households where the forbearance was very valuable. But again, it illustrates the failure to target the cash replacement policies. Okay, so next slide, last slide. Thank you. An example of why targeting was important is what's generally called the hospitality sector. So I think it's primarily restaurants, but it's also hotels and other tourist type expenditures. So the total you see at the top is the total decline and recovery of employment. And at the bottom is same numbers, same scale, just the hospitality sector. You can see hospitality is a non-trivial total. It's not a very big sector. It's only 20 out of 160. But it was a very focused sector. And again, it's an important sector from the point of view of distribution because it's a sector who's very intensively low-skilled, low-wage, just exactly the people who needed to potentially needed the cash. But we didn't have any special program for hospitality, and here's an important number. 65% of all American workers work at a desk and use a screen, a flat panel screen. Those are all people whose work could be easily relocated to home. Of course, they weren't, not many of them were in the hospitality sector, but those are people who didn't suffer very much, but they all got these widespread cash injections anyway. So from that point of view, Congress behaved as if borrowing never had to be repaid, which I think is an illusion that has having a dangerous effect on policy. We're building up. We're going to hit national debt of in excess of 1 year of GDP pretty soon, according to realistic projections. And we went a good part of the way with these multi-trillion, and it looks like now we're going to have some more. So it's a subject of concern. And the failure to target and find out where the harm was really occurring and treat those people generously was lost in exchange for just throwing money at large numbers of people who were not particularly affected, like everybody whose work could be moved home didn't suffer very much in dollars because those jobs could be preserved. Okay, well, let me stop at that. And get another shot at the end.
Thank you very much, Professor Hall. Very interesting discussion, highlighting the main features of the United States policy response with emphasis on cash flow replacement and forbearance and loans and so on. And then I take as a main comment or subject for discussion the need to better target these policies so that essentially these resources that have been spent in alleviating the effects of the pandemic are more effectively used, not, for example, directed towards agents that might have not needed those resources. That would be something that we might actually talk about, I guess, in the second round. Next, let us go to Augusto de la Torre. Augusto, please, welcome.
Thank you, Roberto. Are you listening to me well?
Yes.
Perfect. I am very thankful for the invitation to this very interesting conference that the Central Bank of Chile has organized, and very happy to see so many dear colleagues and esteemed friends. To your question of what worked and what didn't, I think it's a good idea to evaluate what worked by taking into account what was intended. So I think we should take into account what were the objectives to evaluate the things that may have worked or not. And I see two different objectives in the minds of policymakers. One, which may be called stimulus. That's the idea of preventing a big expansion in the output gap and sustaining total aggregate demand to avoid excessive contraction. And the other one, which I guess we could call relief, which is putting cash in the hands of families, particularly the poor ones, and workers, and allow them to survive during the confinement of the pandemic. So stimulus versus relief, and I think the assessment of what worked or not depended on whether what you wanted was a stimulus or whether what you wanted was relief. But the other dimension to assess what worked and not, I think, should be the degree of resource constraints. And the variance in resource constraints across countries is gigantic. At one extreme, you have countries that can borrow freely or print money without any cost, obvious at least in the short run, and have huge fiscal space, reserve currencies, and that's essentially the rich countries and some of the emerging markets that have more solvent governments. But there are other countries like mine, Ecuador, which has no fiscal space. It doesn't have its own currency, doesn't have a central bank. And so you have a government that cannot help itself, let alone help the rest of the economy. So what worked and not also depends on the resource constraints. So objective subject to constraints, I think, is one way to evaluate what worked and not. So in the first dimension of stimulus, I think it seems that things did not work. I recently did a scatter graph where you do a simple two-dimensional one. In one dimension, you put the size of the expansion of the fiscal spending, and you can complement that by the size of the expansion of other governmental supports in credit and liquidity. And on the other dimension, you can put the size of the growth collapse, how much growth fell between 2019 and 2020, and you see no correlation. So there's nothing that says that governments that spent more, that provide more stimulus or intended stimulus did better. And in fact, what happened is that even if government provided stimulus by transferring resources, people did not spend. As Professor Hall was showing, people just saved. There was a sort of a repressed consumption. People could not go to restaurants, they could not go on vacation, they could not go to the movies. So there's a huge increase in private savings of a bit of the forced type, and a huge decrease in investment, which of course stands to reason because the uncertainty is so big that people, it pays to wait and see before you decide to invest. So even though you see huge expansion in fiscal deficits throughout the region, the current account has changed little. In many countries, current account deficits have actually come down. So the excess of private saving over private investment has dominated the macroeconomy. And as a result of that, one can say that for those who wanted a stimulus, what we found is that fiscal policies, monetary policies, credit policies had very little traction. Currency devaluations had zero traction. And so that's one area of assessment of what may have worked or not. However, on the relief side, I think the news are more positive. And the relief took two forms. One, to sustain the capacity to live of the poor. And this in Latin America, at least, was largely done by sustaining and expanding the conditional or non-conditional cash transfers. And the second dimension of relief was to try to keep firms attached to their workers and hibernating until things get better. And that for countries that had the resources essentially implied various forms of wage subsidies and concessional lending or quasi-grant availability to firms. What seems to me, and then of course the evidence is scant still, is that in the area of transferring resources so that the poor can live, we have not done that bad. At least when I look at what happened in Ecuador, a government that was tightly constrained, the payments that were all made on time were the transfers. Small amounts to poor families, and then the program of transfers actually, the government found ways to reorient expenditures to make space for a doubling of the coverage of the transfer program. So in Ecuador now you have about half of the population is receiving some form of governmental transfer in the middle of the scarcity. And this was, of course, complemented by a number of measures of forbearance, preventing evictions, sudden evictions, preventing the suspension of electricity and telephone and internet services to those that were not able to pay, and allowing banks to not show all the deterioration of loan recovery. So forbearance, in a sense, was complementary to this idea of helping people to stay healthy and to eat. The other dimension of relief to firms and workers, again, what you see is a huge difference of countries that have resources, fiscal space and monetary credibility. You see liquidity made available to firms and transfers to workers. And I'm not sure how that has worked. I was very interested in Andres and his colleague paper that shows that at least credit guarantees have had some mixed results. But what I wanted to mention, again, based on in the case of Ecuador, is that the government could not help itself, could not help anybody that didn't have money other than sustaining the conditional, the cash transfer programs. It didn't have money to do anything. So public policy did not die because you still can do coordination services and do regulatory and legal changes to facilitate coordination, because in this type of situation you have an exacerbation of the distance between private interest and public interest. People want to keep the same share they had of a pie that's shrinking, and so you need coordination. And in the case of Ecuador, I would say three services of the government seem to have worked relatively well. And they all came in response to a string, massive string of firm closures. When firms stopped selling, particularly restaurants and entertainment industries and hotels and tourist services, when sales collapsed and became near zero, what you saw in Ecuador is that companies didn't have legal room to just hibernate. They were required by law to continue to pay wages. Legislation made it very difficult to lay off without high costs. So what happened is that many firms in Ecuador avail themselves of a legal clause that allows firms to close without any cost if you can claim that it's force majeure. So many firms started claiming force majeure, and you saw a very large string of firms that were just closing, and the workers were on the street. And so in response to that, and without resources to deal with this, fiscal resources to deal with this, the government created two, I think, important avenues to try to mitigate the problem. One of them was to promote burden sharing. So an emergency legislation was passed that allowed, through simple protocols, for entrepreneurs to come to agreement with workers on reducing number of hours and reducing proportionally the wages, and postponing certain payments to suppliers. This type of agreements between stakeholders, concordat type, accelerated concordats, that was made available. And so the string of closures was stalled to a large extent, and what you see is a catalog of a large number of firms that started doing this type of agreements among stakeholders to share the burden. At the same time, the government managed...
Sorry, Augusto, you have about 1 minute.
No problem. At the same time, the government managed to do some burden sharing with external creditors and achieved a significant rescheduling of the debt, and mobilized a lot of multilateral resources, including through a very large IMF program. So that was an interesting dimension that governments that are tightly constrained out of desperation had to do, which I don't see in other countries in Latin America. And the second one was Ecuador did a number of significant reforms to labor market contracts to also enable firms to survive and to avoid too much of a destruction of formal labor. Ecuador did not have fixed-term contracts. They were introduced with low hiring and firing costs, project-related contracts, and the law or regulatory changes gave firms the capacity to reorganize hours, reduce hours of work, reorganize, put some hours for the weekend at night without additional charges, which was the thing of that used to happen. So it seems to me that those things are interesting experiences that I have not seen in other countries, and maybe a case where, given no resources, given no fiscal resources to throw the safety net in big amounts, there's still room for government policy to solve collective action problems, allocate the burden a little more fairly, and thereby avoid excessive job destruction and interruption of economic activity. So let me leave it at that.
Thank you very much, Augusto. Thanks for the emphasis on the different objectives, the intentions of the government in trying to provide stimulus and relief. Your assessment, as I take it, is that stimulus generally has not worked as intended, whereas on the side of relief, there has been more positive news, both in terms of transferring, for example, giving transfer to the population, and also a very interesting efforts of the government at solving coordination issues, being more active than in all Latin American countries. I think that provides a lot of thought for material for discussion. Let us go to Norman. Loayza. Loayza, the floor is yours.
Thank you very much, Roberto. Let me see if I can share my screen. Can you see it well?
Yes.
Okay. Well, thank you very much. Thanks, Roberto, and thank you all organizers of this conference. It's a pleasure for me to share the virtual stage with Professor Hall, with Augusto La Torre and Elías Albagli, whom I have known for many, many years. I was debating whether to wear a suit with a tie for this conference, but I can see that I would have been grossly overdressed. So I'm glad that I'm just wearing a shirt. It's I was in many of these conferences 20 years ago when I was at the Central Bank of Chile, and I remember how formal those conferences were. So what a change. All right. So let me speak about the evidence that we have collected at the World Bank and the assessments that we have on family and firm support to face the COVID-19 crisis. And I will be basing my remarks on what we have done in our group here in the research group, but also throughout other groups, other teams at the World Bank. And the outline will be the following. Well, for this first round, I will discuss what has been done to support families and firms around the world. And I will also try to assess the success in the support to families and firms. In round two, I will try to explain what we think should be the goals of resilience and also the goals for medium-term, long-term reform. Let me say at the outset, in terms of what has been done to support families and firms, that we had from the beginning the opinion that Augusto has expressed, that when we had the choice of stimulus or relief, it was misguided really to have policies that would try to stimulate the economy when the government themselves were trying to contain economic activity because they were trying to deal with a pandemic. And one of the cornerstones of that policy was based on lockdowns, social distancing, and restriction and reduction of economic activity. So I will concentrate my remarks on relief measures. So what has been done to support families? This is a summary of what we can see all around the world. We can divide what has been done to support families in three basic types of programs. The most important of them by far, almost a third, is social assistance programs, of which the most important are conditional and unconditional cash transfers. Second place takes social insurance programs. Probably the most important of them has to do with unemployment benefits. And third, active labor market programs, such as wage subsidies and training. Now, there is, of course, differences across groups of countries. And what we see is that for low-income countries, social assistance was a lot more important than for other countries. We can just take a look at the contrast between low and high income countries. For high-income countries, there is sort of a balance between social assistance, social insurance, and this active labor market policy. Whereas for low-income countries, most of the social protection takes the form of social assistance, that is cash transfers. For lower middle and upper middle countries, there seems to be also a transition of the kind of social protection that governments are able to supply. This we find as very interesting. The patterns actually hold also if we look at regions. Latin America, it's a circle with a oval red oval. features something in between upper middle and lower middle income countries, with much of the program based, 70% in fact, on social assistance, 18% on social insurance, and just 11% on active labor market policy. Well, let's turn now to firms. And you'll see that actually what has been done to support small and medium-sized enterprises is relatively similar. Nowadays, I mean, we will find some areas of overlap with respect to what has been done to support families. The most important of these different types of support is through debt financing, that is giving some support related to the finances of the firm. Second one, in terms of importance around the world, is employment support, basically wage subsidies. Third, tax supports has taken many different forms, for instance, deferral and rate reductions, and sometimes even waivers for corporate tax. A fourth category is related to business costs, of which administrative fees are very important. And then a number of others that have varied quite a lot across countries. Again, there is a considerable difference if we look at different types of countries, different groups, especially by income. Well, first, let's consider some similarity. Debt finance has been used by all countries to a very large extent. So it takes the lion's share of the support for all countries. Employment support becomes very important for high-income countries, much less so for developing countries. For developing countries, tax support and reducing business costs, especially fees related, for instance, to utilities, become important. And if we look at Latin America, again, it behaves similarly to other upper middle and lower middle income countries, with debt finance being about half of the support to firms, and about the same for employment support and tax support, and the rest for other measures to reduce business costs. Now, the impact of COVID-19 on firms has been severe and widespread. I think we knew that from almost the beginning, and the persistent effect, there has been a persistent negative effect on sales. Interestingly, though, this adjustment has mostly operated through the intensive margin. And by that, I mean that it has mostly been done by reducing the number of hours of work rather than firing or laying off workers. And this is something that we see across many different countries, different income levels. Smaller firms, as you might expect, firms face disproportionately greater financial constraints, and those firms that are able to adapt, especially those that rely on digital solutions as response to the shock, have adjusted better. What is very clear is that the future for these firms is uncertain, and this is particularly the case for those that have already had a large drop in sales. And for them, there is some link with job losses. Well, that is the effect on the firms, but it's, as Professor Hall said before, it's really difficult to assess now the success that these relief policies have had already on families and firms. But we can take a first stab at this assessment, and I will propose 4 different areas that we can consider when we try to answer this question: when has the support to families been successful? Number 1 is comprehensive coverage. That is, whether these support and relief measures included the poor, the vulnerable, and the informal. timely distribution of support, basically to implemented to match the lockdown restrictions and the economic bust that ensued. Sustained and sufficient support that is proportional to the loss of income to cover basic necessities. And as you can imagine, there are trade-offs between all these different different characteristics. So, for instance, in order to obtain higher coverage, it is possible that sustained and sufficient support will have to be diminished. And if you want to be more comprehensive in terms of people that receive the support, this might have an effect on the timely distribution. So higher coverage, but probably distribution not as timely as needed. So there are important trade-offs, and countries have faced these trade-offs in different ways. There are, however, ways of solving these trade-offs and taking these characteristics well. And what we have seen happening is that pre-existing delivery capacity has played a very important role in resolving these conflicts or these trade-offs. That is, whether there were social protection programs already in existence, that has helped, whether the population had a financial inclusion, whether also there was digital inclusion, and whether people were identified through a national or universal ID system, and of course, if the country had the fiscal space to undertake these relief measures. And let me here reflect on the important difference between two groups of countries that are very far away, Latin America, where you are now, and East Asia and Pacific, where I am located presently. What the basic difference that we see between the two is that Latin America did have social protection programs that were already in place. East Asia and Pacific didn't have much of it. In fact, the country where I am now had basically no social protection programs. But East Asia and Pacific was better than Latin America in terms of financial inclusion, digital inclusion, and fiscal space. And what happened in East Asia and Pacific is that they used this pre-existing delivery capacity to scale up very quickly their social protection programs. Latin America didn't have this financial inclusion and digital inclusion and the fiscal space, and because of this, even though they had social protection programs, they were not able to expand them sufficiently. So just to give you an example, in Argentina, for instance, there is a social protection program, there is a cash transfer program, but it was used to cover about 20% of the population, but the amount that was received by these families amounted to only 10% of the minimum income. So very little in terms of what was given. That was very much in contrast with what happened in East Asia and Pacific, where the amounts of money, the timely distribution, and the coverage increased dramatically and reached even populations that had not even been included before. For instance, informal workers.
Norman, you have about 1 minute.
Yes, thank you. So I have this last slide. This is also about assessing the success of support to firms. So one has the support to firms been successful. And here we have some characteristics that I believe are important. Ensuring firm worker continuity, promoting innovation and firm renewal, and being well targeted to support the firms most affected. There are also trade-offs and conflicts between all these characteristics. As you can imagine, in Europe, for instance, firm worker continuity was emphasized, whereas in the US, innovation and firm renewal were emphasized. Now, this conflict is important, but it can be resolved if we look at programs that are well targeted and also if we look at programs that promote economy-wide productivity. In particular, here I will signal digital transformation. So I will stop at here, and thank you very much.
Thank you very much, Norman. Great summary of what has occurred in terms of programs of support to families and firms. I learned that, for example, in terms of support to families, social assistance programs transfers have been dominating, although there is quite a bit of heterogeneity by income and region. On the other hand, in terms of for firms, social support to firms have been dominated by essentially debt support. I was particularly interested in the evaluation of the determinants of the success of these policies, and in particular what you call the pre-existing capacity, especially inclusion in terms of financial inclusion and digital inclusion and physical space, in terms of success of programs for households, and in terms of success of programs for firms. The question, the comparison between Latin America and Asia, that on the one hand, Latin America had better social protection programs in place, but Asia had more inclusion, and Asia seems to have better. So that's something that that provides a lot of material for discussion. So let's end this round with Elías Albagli. Please, the floor is yours.
Thank you, Roberto. It's a real honor to be presenting in this panel with this distinguished guest. Let me start with a quick list of the main measures that have been deployed in Chile. As the Governor Marcel discussed yesterday, on the monetary policy front, the bank was rather quick on cutting rates to the effective lower bound, complemented with a strong message of forward guidance and an asset purchase program. But also the bank deployed, in coordination with the government and and the financial regulator, the conditional lending facility, the FSIC, which essentially makes advantageous loans to banks conditional on banks expanding their balance sheet, their commercial loans, right? I'm going to be talking about this particular measure, the success of this measure. On the fiscal front, we've had a series of transfers. Some are above the line, so the direct transfers to households. Some are below the line. There are implicit credit guarantees to the program that I was just discussing. And there's also been more recently employment creation subsidies, which are already starting to make a difference in and supporting further recovery of the job market. There's also been some important regulatory changes that I would like to include in my discussion. The first is the Employment Protection Law, which essentially allows workers to access their privately funded unemployment insurance without the need of them being fired, right? So that basically allows, if you are put on hold on contract suspension but not termination, an important difference made by Professor Hall before, then this change in the law allows you to actually draw from your unemployment insurance. It's really a regulatory change. There's also been a special financial regulation to assist this COVID forgiveness program. And importantly, there was an extraordinary constitutional amendment that allows all households, to withdraw, to make a partial withdrawal of their privately funded pension savings. Okay, so there was a first withdrawal of 10%, roughly 10%. There's a minimum and maximum roofs and floors, but it's roughly 10% of your balances. And then that was quickly followed by a second withdrawal, also 10%. So basically, on average, households have withdrawn something close to 20% of their previous savings. This is a lot of money. This is the privately funded pension system in Chile is about 85% of GDP, accumulated assets. So 20% of that has been withdrawn in the last couple of months. I will be talking about this, the impact of these measures. So first, I would like to say a few words about how we evaluate the first program, this triad of liquidity facility by the bank, the credit guarantees to support these loans by the government, and the special financial regulation by the CMF, the financial regulator, to allow these loans to go through. And then in my second part, in this first part of the intervention, but on my last couple of slides, I would like to talk about what I am allowed to say really about the impact of the fiscal response. Okay, so here I'm not really gonna evaluate whether this was optimal or not, but I am gonna present some quantification that I think is helpful when we discuss how targeted these policies have been and their relative magnitudes in terms of how they have mitigated the significant drop in earnings by households. Okay, so let me start first with the program, the lending program. So as was noted yesterday, we see a first very clear sign of these are the good news that Professor Velasco signaled yesterday, right? So we have for the first time a counter-cyclical behavior of credit. This is credit from banks to businesses. So essentially, a measure of the bank lending cycle. So this is basically the lending from the difference from lending with respect to a trend that has gone up in the beginning of the COVID crisis, while at the same time the output gap was opening widely, like in other countries as well. Now, this is a necessary condition for credit to get to firms, but it's not a sufficient condition for this credit to make a difference. Okay, and I guess the key point here is who is getting the money, right? On the one hand, you can expect that this is what I expected to find in the data. Actually, I expected to see that a lot of firms that were in relatively good condition will get the funds. They were probably worried about having funds in the future, so maybe while they have access, they better ask for the money. And if that was the situation, and there was a comparatively little lending to smaller firms, I'm sorry, not smaller, but more affected firms, then we could still have a very significant increase in bankruptcies and firm closures, despite this very impressive rate of credit growth. So, but to try to evaluate that, I mean, this is impossible to do with aggregate data. So in that sense, access to microdata has been very handy. We had, as Federico and Andres were pointing out in the morning, we have this microdata that allows to merge sales, basically real time, with access to credit by firms and all other many other dimensions like employment and so on. What are the key findings? First, the money not only credit grew on the aggregate, it actually went to the most affected firms, as well as those that were doing comparatively well, as you would expect. So that means that this access to credit has at least the potential of reducing the impact on the real economy. Then when you the results that Andres was pointing out in the morning, when you actually do that exercise, you formally run regressions between outcome variables and access to credit, you confirm this intuition. essentially firms that had access to credit, to this FOGAPE COVID credit lines. First, they were significantly less likely to exit, to stop producing and selling. They were less likely to actually cut on investment. That's something that Andres didn't show, but it's also comes up very clearly. And also less likely to cut employment. So I think this is as specific evidence as you can have to actually evaluate the policy. I would say, in a nutshell, this policy worked. Of course, now firms have a lot of debt. So in my next intervention, I'll talk about that. But before closing my remarks, Roberto, I would like to spend a couple of minutes discussing the effect of policies on the fiscal side. Okay, so this graph, this has a lot of information. I'll try to be as clear as possible, but I think this is a very good summary of the COVID crisis from the perspective of households. This is a graph that came in the monetary policy report in December. And what it does is essentially constructs for each quintile. So basically, we split the population in quintiles, right? 20% in each bucket. The first quintile is the poorest fifth of households. And what we see here, what we try to capture, is how the drop in earnings, that would be the negative blue bars, whether and by how much that was compensated by other policies, right? For each percentile of the wage distribution. What we see here, I would summarize it in three main messages. First, we see that fiscal transfers, those are the red columns, have made the biggest differences on the lowest quintiles. So I would say fiscal transfers were pretty well targeted. Okay, I gotta admit there's some estimation here, there's some assumptions. This is not we don't have information for each household like we do in the case of firms, but there are some surveys that allow you to do reasonable matching, and so I would be relatively confident with these general conclusions. So, but the second message that comes up from here is that in the aggregate, the pension withdrawals, these first and second withdrawals of 10%, are the dominant source of compensation when it comes to the liquidity position of households. I want to be clear that these withdrawals are not income, right? These are savings that households had, and basically they're drawing down on their savings. This was not legal to do before. The change in the constitution allows households to do that. What's the effect on that? Well, that's really the dominant, that's the lion's share of the compensation in lost income. Actually, if you do the math here, what this comes up to is that basically for all quintiles, the first withdrawal already, and coupled with the fiscal transfers, already put each quintile of the wage distribution above the water, right? So you have a positive increase for all quintiles. Then when you add the second withdrawal, this is just a very high increase, right? So on the aggregate, the liquidity of households, this is for the whole year, for 2020, is 17, it's almost 18% higher than last year, right? And this is taking into account that, the loss in incomes put you down by 5%, the transfers from the government put you up 3%, right? So you would be on net 2% below water, and then you add the two withdrawals, and that puts you above almost 18% year on year. So I'm not gonna say anything whether this is optimal or not, but let me just, I think I can make a more positive statement in the sense that the pension withdrawal measures do not seem to be targeted measures, right? In the sense that when you take the average for each quintile of the wage distribution, you see that there's an enormous amount of resources being deployed here. But perhaps I'm pretty sure that if you open this up, if we were able to open this up, we would still see that the households who are actually taking the worst hits, those that are unemployed, that have been unemployed over the last 6 months, maybe for those, the withdrawals are just putting them sort of breaking even, or maybe even below water, right? The point here is that this measure is for everybody. It's not targeted. I mean, it doesn't matter whether you lost your job or not. So the aggregate numbers, this is what they show. They show that despite incomes falling 5% on average, these pension withdrawals have amount to a very, very significant increase in liquidity at the aggregate, which I would expect will, and this is the implicit in the projections of our latest monetary policy report. This is giving a very important support to consumption for 2021. And I will leave it at that, and I'll be happy to come back in the next part of the session.
Thank you, Elías. Very interesting, important discussion, especially of the case of Chile, where you highlight that there has been some progress in terms of essentially giving credit, especially to small and medium enterprises in Chile, as discussed earlier in the paper by the Central Bank of Chile in the previous session. And then the question emerges more on the side of the households, different programs of support of households, especially the role of the pension withdrawals, where has been apparently the dominant source of the compensation for lost income. You highlighted that more than compensated for lost income, and on the other hand, it's a program that has been not targeted. This is actually a good segue to move to the next part of the discussion, which is looking forward. What are the main challenges that we face in the coming months in, say, continue providing support for firms and households? What should be priorities, key trade-offs, and urgent actions? I mean, what kind of changes or corrections do we need? I think that, as announced, we are going to go in reverse order. So I guess Elías goes first in this round, and probably you can go in reverse order. I might actually ask again the question of what has been, for example, the role of the pension allowances in this, and how it should change, if you think so. Go ahead.
Am I muted? No, okay. That's great, because that allows me a lot of continuity in my presentation, so thank you for that. Let me just say now a few words on what I think we can learn about the deployment of different measures going ahead for what I would call the second half of the crisis, right? So I think that most of the programs mentioned were crafted and implemented in this first half of the crisis, but this is a topic that came out very clearly in the discussion yesterday. I think we are pretty much all in agreement. The crisis is taking longer, right? I mean, these programs were deployed thinking about an economy that would probably recover in the second half of 2020. And now it's looking more like the second half of 2021, right? We've seen very vicious second and third waves of the virus. There's some new mutations. Actually, one could think of a scenario where we all get vaccinated, and then by the end of the year, there's a new mutation, and maybe, you know, now it takes less time to redesign the vaccine, but it's still going to take some time. So I think this puts us in a scenario which is on average worse, right? On expectation is worse, and it's probably also more open in the sense that it's more uncertain than, for example, the one we might have thought even a couple of months ago, before these mutations in the virus started showing up. Now, even if the virus is controlled around the first half of 2021, and there are no further important surges in contagion, there's another very important source of uncertainty, which I think many of the papers that we've seen have pointed to, which are the scarring effects. We don't really know the scarring effects in firms, in households that the crisis has left behind. Okay, and we will probably only learn about them as time elapses and we start measuring things like productivity and the type of jobs that get created and so on. But I don't think we have the information right now or all the information to make a great assessment. So thinking about the next couple of months or the next year, can we rely on the same set of policies in those scenarios where things don't move so smoothly and we face further problems? So let me put a graph here that I think it's a little bit of a warning sign. So the other side of the coin of this policy that I highlighted at the beginning, the lending to firms, I think this policy worked pretty well. But now what do we have? Now we have firms that are on average 50% more levered. That's basically the magnitude. So this is shown here in the graph for all different category of sizes for firms. And you see this happens all across the board. This is this is total debt. This is debt with the banking sector. But if a big firm is issuing a bond, this is also captured here. And essentially what we do is, as a measure of leverage, this is the total debt divided by your average quarterly sales. Okay, so the level doesn't really matter. What I'm really trying to show here is the change. And I do want to be clear that this change is not being brought about by the fall in sales. So this is not because the denominator is lower, because we're actually normalizing by the sales before the COVID, okay? This is basically an increase in debt. Firms have increased debt in roughly 50% across all size categories. So this is a huge surge in debt, which was intended. A couple of months ago, this was a sign of success. I think it's still a sign of success. But of course, it brings a whole set of questions. One being, if things get worse, can we pull off this trick again? I don't think we can. I mean, there's clearly less room. I mean, we cannot expect firms to increase debt 50% again, right? The limits to the debt ceiling is much closer now, okay? So I think there's not a lot of room as we had before, and probably if things deteriorate significantly, more action on the fiscal front is going to be needed, okay? So to talk about this issue, I think it's important to put some points in the discussion. Is it optimal, efficient to salvage firms? I think there are good arguments to think so. The first is that if we think that the damage is transitory and is due to lockdowns and social distancing, then it makes sense to keep firms alive, or at least some firms alive, right? Firms, bankruptcies of firms have all sorts of externalities. They have network externalities on the other firms. They destroy very valuable matches with the workers, right? The implicit buildup of human capital through job ladders through time. So when you destroy these firms or these matches, that can be hugely costly, right? Of course, in real time, you don't know which firms you should salvage, whether it's worthwhile to salvage firms that perhaps after the crisis are going under anyway. So what do you do when you are facing a situation like this and you have a lot of uncertainty? So here I want to draw on an insight by one of my advisors, Jeremy Stein. I think he's putting forth a great idea. I haven't seen this discussed too much on the policy side, but I think this is going to be with us in the next couple of years. How do you deploy government money to assist firms? Okay, and here you can think of loans. You can also think about equity injections or just simply grants. This is just the best way of putting this money out there to maximize the returns that you get from it. So basically, it works like a venture capital, right? When you have a lot of uncertainty, like the venture capital industry does in general, the efficient way of allocating resources is that you allocate them in steps. You start and you give money maybe to, I don't know, most firms, maybe all firms for the next couple of months. And then you see how the firms get along, and the ones that are actually doing better, you can keep on the financing, and then further rounds for firms that were really doing very poorly, despite the economy recovering, maybe those are the firms you don't want to finance anymore. Now, this is a neat idea in theory. I am under no illusions that anything like this can pass through Congress. I don't think this is something you can sell politically. But we will, I think it's very likely that we will have to have this discussion. I mean, I don't think we can keep on expanding credit, at least not in the magnitude that we did before. So we're going to have to think about policies along this line. And this is, by the way, here I'm not talking about Chile. This is just a general I think it applies for most countries. Let me pass through the context of households. I think a very relevant lesson for the first half of the pandemic, and this I think was also a point that brought by Andres Velasco yesterday, if I'm not mistaken, is that it is crucial to deploy fast and fiscal support transfers to households, not only from a consumption smoothing or welfare perspective. I mean, that itself, of course, justifies it. But there is a second issue which maybe was not so clear when the pandemic started, which is an actual lesson from this pandemic, is that when you do so, people stay at home. So basically, when you are successful in deploying these funds, you are actually also successful in bringing down the contagion numbers. I don't think this was attained in Chile, at least in the first couple of months. There was some delay in the deployment of these funds, and I think one of the reasons that the funds were delayed is that, well, if you're the government, you try to make a targeted program, but making something targeted makes it cumbersome. It involves delays, and this is what I want to base my remarks on, Roberto. How do you minimize these delays? Here, the key message is you need to rely on information. We have a lot of information in Chile. Now, this is not going to work for many countries that don't have information. But the point I want to make is that in Chile, we have this information, but we do not use it. I mean, we gave some examples in the morning. The central bank is using this information to design and evaluate policies. But when it comes to the public policies more general in Chile, I think the very rich administrative data sources that we have are severely underexploited. I don't think this is so much an issue of government inefficiencies. I think the core of this problem, and this is something that we need to deal with, is that the public has a very negative perception of the government using their information. They are very worried that the government accessing their information would lead to all sorts of compromises on privacy, and information can get filtered and so on. And I mean, I think this is a valid concern, but I think we need to have a more informed discussion on this point, because I think that today, I mean, it's becoming very clear, information grows, right? And I think that a modern state's key asset today to help its population is information. And unlike many countries, Chile has this remarkable wealth of mergeable information sources, but we are not deploying them. And we need to bring home the point that it is possible to merge this information while at the same time keeping, without compromising the individual privacy of citizens. So that in the end, when somebody loses their job, they don't have to apply to anything, because this shows up in the IRS. This shows up in the forms in the electric. I mean, it's informed automatically to the labor bureau. So why do people have to fill out forms to show that they are unemployed? They don't have to, right? I mean, they could just receive the checks in a matter of weeks, because this information is already in the system. It's just that it's not linked, right? So I think that, I guess you get the point. The point is, we have this information, we have to put it together. The main constraint that I see is that the public does not have a good perception of this effort. And I think this is a wrong perception. It is possible today with the technology that we have to put this information together, put it to good use, and not compromise the privacy of individuals.
Okay, thank you, Elías. Very interesting. I take two very important suggestions. One is that in view of the huge surge in debt, especially in Chile, then we should consider the question of the government getting more active, and in particular getting ready to salvage firms. I mean, that may actually involve having the government work as a venture capitalist of last resort. That's something that is debatable, but it is something to think about. And then the other suggestion is to minimize delays if it's to employ our information much more intensively and efficiently than we've done so far. Let me remind everybody that we're going to have some time for questions at the end. So, but right now, let's go to Norman Loayza to talk about what he expects for the for the next few months.
Thank you, Roberto. I'm trying to share my screen. Let's see. All right. Can you see it well, please?
Yes. Thank you.
Thank you. All right. So what can we expect in the next few months, and maybe if we are more ambitious about what can we expect for the long run? In the next few months, a necessary condition for economic recovery is the resolution of the pandemic. And this is, I think, a point that is worth stressing, that without resolving the public health issue, it will be really hard to conduct any program of economic recovery that can be sustained. And we have the wonderful news of successful vaccines. We thought maybe a few months ago that might be two successful. It seems that almost all of them are good vaccines. And now the challenge is vaccination programs and deployment. And we see that many countries in our region, in Latin America, are very much behind in terms of getting the vaccines and then deploying it in their populations. In the absence of a vaccine, the insistence of smart policies to contain the spread of the virus, that is testing, tracing, use of masks, social distancing, and other non-pharmaceutical interventions are indispensable. So I'll stress that this is a necessary condition for economic recovery. Now, while we are in this emergency time, and this is what I think, should expect in the next few months, rather than thinking about quick recovery, we should be concentrating on long-term resilience. And by that, I mean protecting the fundamentals of economic growth, protecting human capital, physical capital, and productivity. And this may be very basic to start with, but it has consequences for the way that policies are run. On human capital, for instance, children need to go back to school safely. And we need to keep protecting vulnerable families by providing this relief assistance. Physical capital and investment, on the government side, we should insist that public investment is of high quality, not just of any quality to promote, for instance, the stimulus that may not last. or may have a very low multiplier effect. Fiscal moderation is probably a more prudent way of going through this intermediate phase between the worst part of the pandemic and full recovery, and policy certainty regarding what governments really intend to do in the coming months. For productivity, we have already seen the importance of avoiding unnecessary business closures. But I want to stress here the word unnecessary. Some business closures are inevitable, unavoidable, and to probably proceed for the economy to keep innovating. And in that regard, in the regards of innovation, facilitating online business practices seems to be very important, and that's something that can be done even in the short run. Looking more now at the long term, I think we can see this crisis as an opportunity to promote necessary reform. I know that it's hard to think about positive effects or positive aspects in the middle of such a profound crisis that we are experiencing now. But we have had crises in the past, and the outcome of many of these crises, for instance, the inflation crisis, the macro instability crisis in Latin America of the 1980s, led to important reforms to almost all countries in the region. And it's our expectation or our hope that this crisis can also lead to necessary reforms. It has really made us think about what is really essential for promoting this resilience of countries and populations. And I will mention a few. The first, I think, is about expanding labor and business formalization. We have realized in the worst possible way how vulnerable informal workers are. And informal workers are about 60% of the workforce in Latin America, and about 90% in Africa and South Asia. And together with formalization that implies, to a large extent, flexibility in markets, is improving the coverage and adequacy of social protection. These two reforms should go hand in hand. This is something that we discussed, for instance, in the case of Peru at the beginning of the Kuczynski administration. And I know that Augusto was very much involved in this process, as I was. Unfortunately, it led to nothing. And we see the consequences of that failure, Peru being one of the countries most affected by this crisis. The third is about financial inclusion, extending it to elderly, rural, and poor people. That's a challenge that other countries have taken with a lot more interest and force, especially in East Asia and Pacific, with much success, as I highlighted before. Promoting digital transformation in school, businesses, and governments. It is very clear, for instance, that the kids that have access to online services will fare a lot better in terms of their studies than others. The same can apply to business. It's applying to businesses. Those that have been able to tap on digital resources have been able to continue their work. And governments have been able to provide services also on a continuous basis if they have access to these digital platforms. And the last, of course, very clearly seen now in the case of this public health emergency, is that we need to improve access and quality of public health care for the whole population. In a sense, this goes hand in hand with the social protection measures. So I believe that this is the agenda for reforms in the medium term, and we use this crisis to promote them. At least there will be something good coming out of it. So, thank you.
Thank you very much, Norman, for your discussion and proposals. One in the shorter term, you emphasize that The vaccination question is the most urgent, obviously. Vaccines are here, but we still have to think about deployment in a fast, ample, effective manner. In the meantime, we have to continue smart health policy, but in the long run, also, you have emphasized we have to think about trying to emphasize resilience of capital, both in the human sense and the physical sense, and productivity. And I guess you are hopeful that this crisis is going to be an opportunity to enact important reforms on a number of fronts, for example, formalization or public healthcare. I think I'll leave it for the discussion to see, how feasible people might think that may be in what we are observing right now. But now let us go to Augusto de la Torres. To talk about what to look forward to.
Thank you, Roberto. So now we are facing the question of now what? So I would like to make a few points to organize a conversation. First, I think we have to be very conscious on what the recovery will depend, which are factors exogenous to economic policy. And I think there are at least three. One, the state of the world. How fast, how vigorously will the world recover? Will China pull a fast growth in 2021? The manufacturing sector does seem to be doing relatively well. So the state of the world is crucial, including the points that Carmen Reinhardt was mentioning yesterday, how wounded balance sheets around the world will come out of this crisis. So you have a great deal of uncertainty on that, and it may be more of a given for Latin American economists. Second, the necessary condition of the effectiveness of the fight against the coronavirus, and in particularly the effectiveness of the vaccine, which is so far not a slam dunk. There's still uncertainties on this, and you may have waves, but that is crucial, as Norman was emphasizing. And third, I think it will depend on economic and institutional flexibility. It will all depend on how fast and how well will corporations and economies will adapt, and that requires a degree of flexibility that's very important, and how flexible can be a public policy response. And so different countries have different degrees of flexibility, and that's an issue I want to come back to. Now, in terms of what the priorities going forward, I see three areas for us to think about. One is the nature of the rebound in the Keynesian style, using available capacity and available resources, the shape of the rebound. The second dimension is something that probably is better to be defined as restructuring. Not everything will be rebound. There will be some unviable and insolvencies in corporations spread around, and so much of it will be a question of restructuring, reorganization, liquidation, recapitalization, and that's a big field. And the third one, I think, will be very crucial, and it should not be an afterthought. It should be an integral part of policy thinking, which is the dimension of social equity. As we all know, this crisis is extremely regressive, and the nature of the social tensions and political tensions that may introduce is still unknown, but I think it will play a huge role. So as we look at economic recovery, we cannot lose sight of the social equity field that needs to be addressed in parallel. On the rebound, there's a lot of ready-to-use resources, recall and employment, as Professor Hall was saying, machines and equipment and buildings and capacities that can easily put back to work as long as there's demand. Aggregate demand is likely to be there because there has been so much accumulated private savings that can be drawn down. And this repressed consumption can be unrepressed. A key question in the rebound is how much can governments help? And of course, it depends on how solvent governments are. So one way to define that is that governments that have a low and flat yield curve would be in a better position to intermediate the transfers and the supports and the complements in spending that may be needed for the rebound for the output gap to close faster than it seems at this stage. The IMF, for instance, is predicting that recovering the levels of economic activity, the pre-COVID levels of economic activities, may take us until 2024. So the nature of the rebound is a tricky question. Governments that have the capacity could help by making long overdue investments in infrastructure, for instance, and that can be part of it. The reason why the rebound may be complicated is that much of what will need to happen is not so much just using ready available resources and underutilized capacity, but actually you may have insolvencies there and lack of viabilities in many corporations. And so for that, you need restructuring and you need capital. Essentially, you need a combination of capital and flexibility. Flexibility in terms of reallocating resources, freeing resources, moving them to the better uses. In capital, because when you have that type of problem, more debt doesn't help, right? What you need is actually capital. And we will probably be entering a stage where there's significant shortages of capital. And there's significant needs for increasing flexibility in resource reallocation. One problem that we may have to deal is the problem of zombie corporations and even zombie banks. That is corporations and banks that may have lost their capital strength completely and may no longer be viable, but because of legal constraints, regulatory inefficiencies, they just keep on living. And the problem with that is, of course, zombie corporations trap resources that should actually be freed for new investments and reallocation. So that's a tricky issue because distinguishing liquidity versus solvency problems is always a major challenge. In the area of capital constraints, countries have very different situations, but in most countries in Latin America will find a significant challenge in that regard because we have underdeveloped capital markets. So raising capital on a voluntary basis is not going to be easy, especially if uncertainty is very significant. So that raises the question as to whether governments have policy instruments that can help the process of recapitalization. And already Elías was mentioning some ideas, and I think we have a lot of work to do here on thinking on whether governments can help in recapitalization without creating problems of moral hazard and inefficient allocation, and whether there are ways to discover that and to support what should be supported and not to support what is unviable, which is a common problem for governments. In my country, in Ecuador, for instance, two lines of discussion in this area are at the heart of the debate. One is all of what governments can do to attract FDI. So making foreign capital be part of the solution. And that's, I think, a big area of policy. And of course, some countries have a much more friendly environment for FDI, others don't, and that has to do with all sorts of factors, including corruption, crime, etc., institutional integrity, etc. The other one is, of course, whether governments can do things like acting as Elías was saying, as a venture capitalist of last resort in a wise manner, in stages, or perhaps using convertible debt or subordinated loans. Where the big problem is the problem of selection. How do you direct those resources in ways that make sense? So that's, I think, a big area. But another one that I think is as important, reorganization and liquidation framework. Yeah.
Augusto, yes. Can you take one more minute?
No problem. So these Chapter 11 and Chapter 17 type frameworks are crucial to allow the peaceful death of companies that are no longer viable so that resources can be freed, and to reorganize what can be reorganized. And so there's a big task, because in Latin America, we do not have that type of flexibility in corporate restructuring frameworks, and even less in labor reallocation. Our labor legislation is not particularly conducive for labor mobility. And so the idea of looking closely at labor market mobility with appropriate social protection is, I think, a huge challenge, one that we better start facing. Finally, although I only have 30 seconds, the social equity component. I think one first challenge is to fine-tune the capacity to identify those in need so that the targeting can be improved. For instance, in Ecuador, there's already the expansion of the coverage of the transfers of the unconditional cash transfers that we have there by looking at those people that no longer contribute to the Social Security, which can be presumed workers or households that are falling out of the formal market. So the idea of identifying and target better is a big one. Health services will be a huge part of the discussion. The availability of adequate health services across the board, and not only to those that have money. And finally, I think general redistributive policy, taxing capital income, making the right expenditures, which of course hinges on the credibility of governments. But I think if we at the policy level do not pay attention to the social equity side, whatever we do on the recovery side may not be sustainable. Let me stop there.
Thank you very much, Augusto, especially for the emphasis at the end on the question of social equity and raising the issues about redistribution. Let us just close this round with Professor Robert Hall. Professor Hall?
Thank you. I'll be very brief. One thing that we haven't talked about that is very important to this group of outstanding researchers is research. And one topic has come up repeatedly in the conference, which is scarring. And there's lots of models of scarring, but there's way more need for quantification. So I would outline that as a topic that the kind of people who are here and are highly productive scholars ought to get to work on quantitatively. A related topic, which has only been casually mentioned, is externalities. To have policies that deal with the consequences of adverse events to firms rests on some notion of an externality. We don't put firms in the utility function. So firms are just ways that use people whom we do put in the utility function. So the case for rescuing a firm is pretty tricky, and fundamentally, since correcting externalities is one of the central functions of government. Externalities of unemployment are a particularly important topic, which still hasn't received enough attention, I think, in the research sphere. Another more directly forward-looking issue that concerns me, especially in the U.S., historically the U.S. has been a well-governed country, especially in the middle of, in the years after World War II. But we've really sagged in that respect. And of course, other countries, there's a huge span of competence of government. But in the US, we've really reached a nadir of competence of government. And I just wonder what we don't anymore elect people with executive experience in the US at all. The politicians that get elected are those who spent the entire career learning how to be a politician and get elected, as opposed to learning how to run a big organization like a state or even more the federal government. We badly need a turnaround, and I'm not sure it's going to happen. Okay, with that said, since I'm the last speaker, let me just say a little bit of an appreciation of this wonderful conference. First of all, the authors gave spectacular papers, I thought. I mean, it reminded me of going to the very best conferences of international scholars everywhere. So I congratulate the organizers for picking these great papers, with the possible exception of my paper. And I'd also like to single out Sophia for having bailed me out numerous times so far with the mysteries of WebEx that she's mastered. And one final comment, I'd love to see more conferences, but the next conference should be in your winter and our summer, because then it's only a 3-hour time difference from California to Chile instead of 5. So the 5 is really inconvenient, but you could correct that problem by putting on another great conference in the winter when the time difference is 2 hours less. But thank you again. It was a wonderful conference.
Well, thank you very much. This concludes the rounds of interventions, but I think that we have a few minutes to take questions. Sophia, are there questions in there's at least one question in the chat?
Yeah, there is
Right.
one question in the chat. We'll unmute Daniel. Daniel, you can speak now.
Oh, hello. Yeah, I just wanted to ask kindly about this process of closing non-productive businesses. Is it really good for the overall aggregated economic productivity, or is it that the pandemic is maybe not a fair experiment, that not only the bad businesses close, but also some potential good ones? Thank you.
I suggest that we take a couple of more questions and then let the speakers
Sure.
answer them.
So
Are there
Laura,
questions?
a question / comment. I don't know, Laura, if you want to.
Yeah, I just have a comment. I think Norman said it. This has always been a health shock type crisis, and the resolution of this crisis has always been through the resolution of the health shock. That now looks a little bit better in terms of time frame, but there's still a lot of uncertainty. At least we do know that there are successful vaccines, but now we need to distribute, and it has been tricky. There's countries like Israel that have been very successful and countries like the US that have not. And in Latin America, we haven't bought, and if we bought the wrong ones, and so on and so forth. But this has been known since the beginning, and I thought it was interesting that people are now saying, in hindsight, we spent too much in the wrong places. But this was known since the beginning, and so it would be interesting if also there's some rethinking of why there was this push for this ridiculous spending and targeted to everything and anything that moved, under this view that this would end in 3 months. I was talking to people in Costa Rica, and I was looking at the IMF and World Bank projections, and they had this V recovery that, again, since early on, it was known that it wouldn't be a V. So it would be interesting to later get a sense of what was the political economy that has pushed for this idea that we all know is wrong. Maybe it was a human mistake. Maybe we were all hoping it would end quickly, but we knew it wouldn't. And I do think there will be consequences of the things that we have done. Just to mention, in the US, it's known that these transfers have not been targeted and have had interesting effects. So you see now a lot of people gambling in the stock market and even in the exchange rates. The stock market has increased, it's crazy. Housing, the price of my house went up 10% last year. Like, we do see consequence of these untargeted spending. In some other countries like mine, there has been a lot of corruption in how the money that has been given to people. We also see that in the US, masks have been bought to people that never produce it. So there's going to be consequences. And it would be interesting to get a sense of the political economy of this. Again, maybe it's too early to think about that, but at some point I think it needs to be done.
Thank you.
Roberto, there is one last question by Alejandro Mico.
Excellent. Well, Alejandro, go ahead, and then we ask the speakers to answer as they prefer.
My question is a little related with what Laura said at the end, which has been the role of the monetary policy to the inequality during this period. We have seen that many of the financial assets goes up, and you see that the income distribution has become worse, and that could be that the monetary policy have increased liquidity, and this liquidity has been going only to financial instrument. And what's your opinion of that?
Okay, thank you very much. So I'll just open the floor to the speakers to answer the questions or ask questions to each other, whatever they prefer.
I'll be happy to start, if that's okay.
Okay, yeah.
So let me start with this very, I think it's a fascinating point, question that Laura asks. But I would rephrase it a little different. So I think that there were definitely people, which I guess that would be your view as well, that predicted the crisis would last longer, the health part. And those people were right. And there were other people, which I would include myself. I guess I took what the health ministries were announcing. They were expecting, that if lockdowns were successful, they were expecting them to be successful, that the contagion numbers would go down and the crisis could be over, say, by at least the health part of it by July, August, maybe September. I was in that camp, and I guess I was wrong. But the point is that something is not known. This is a distribution of beliefs around that. And when you come up and you make group decisions, like for example in the bank, I think it's a very healthy process to give a first shot to all opinions, right? And I was in that process, and I mean I can tell you that there's no political pressure here, not in the bank. And I think that we came up every time with the best possible estimate that we had. And actually, even for the people who were wrong, because I mean, we're going to say we were wrong in this respect, the summer of 2020 certainly looked like it was given, it was supporting our view. I mean, the contagion went down like crazy in the US very fast, in Europe very fast. And then we were all happy, and we said, maybe the V-shaped guys are right. And then they were not right? Because then people went out, and then we have the second wave. So I don't know. I mean, this has been a tricky issue. I think if policy would have been maybe a little different, if the reaction of people would have been a little different, maybe the health crisis could have been over much sooner. But I think this is just something very hard to predict. Alejandro asked a very interesting question about inequality. And I think you're right. I think that one of the effects of monetary policy by driving driving up asset prices, which is also a topic that Laura touched upon. This definitely increases income inequality, all right, wealth inequality, to be more precise. But that's one effect. But the other effect is that it probably mitigates the severity of the crisis as well. So I guess we would have to put both things together. But I take your point, and this is something that we've discussed since the beginning. It is much easier to get to firms that trade in the stock market, that they don't ask money to banks. They basically issue bonds. Those firms you can get very fast with monetary policy. And I suspect that when the crisis is over, we're already seeing this. We will have a significant bias towards the identities or the characteristic of firms that survive. Probably we'll have increased concentration in many markets, and that partly reflects the fact that it's a lot easier to get with policy, a lot faster to get with policy to firms that are large, trade their assets, than it is to small businesses. So I think the Fed did a big effort here. In the bank, we did too. But I think that's only a partial compensation for this fact. I don't think that can completely overturn this fact. And finally, there was a question at the beginning. I'm sorry, I didn't catch the name who made the question, but talking about the criteria of salvaging firms. And here I would like to echo a little bit the remarks of Professor Hall. I mean, implicitly, we need to make this explicit, right? If we talk about government policy to save firms, we are of course talking about externalities. There are some externalities about firms going bankrupt that make it optimal for policy to intervene and try to internalize them. And I would also, touching on Professor Hall's remarks, I think we need to do a lot of research in this, right? So to quantify this. At the bank, we've done a little bit. We have this amazing data that shows you which firms buy which from other firms. So we have the whole network of firms transactions for the whole economy. So based on that, Federico Uneos has done very fascinating work, basically computing what is the impact of any given firm in Chile closing down, what the impact of that would be in other firms at the first round, the second round, the third round, etc. So you can compute the effects actually. And but that's not the only effect, because firms, as you will say, hire people which appear in the utility function, and some of those jobs are jobs that have been in place for 2 months. Probably not a lot of human capital has been created. Some of the jobs have been there for 8 years and are the result of people looking and successively going up the job ladder. So they're in a very valuable job from the worker and firm perspective. And when you break up that job, that creates a very negative externality. Thankfully, this is also things that we can measure, at least with our data, and that's also definitely in the research pipeline. Thank you.
Yes, Roberto, if I may, I can take a couple of the questions.
Yes, please, go ahead.
Yes, there's one question that was related to sorting out between viable and unviable firms. And nobody knows how to do this well, because the driving principle of public policy to assist is driven by externalities. But the effectiveness of the policy, and externalities is let's call it, it's part of a collective action type family of frictions. But the effectiveness of the policy depends on other type of frictions, which are kind of the information asymmetry, principal agent type frictions. So the government is driven to avoid negative externalities, but to implement it has to sort out between which firm is viable, which firm is unviable, and that depends on information asymmetries and principal agent frictions, which the government is not good at solving. So the solution has to be a solution where the public policy that's driven by externalities utilizes the abilities of the private sector to screen. And you have these two problems that are obvious. No? One, that you may have unviable firms that stay alive as a zombie, a social loss, or you may have fundamentally viable firms that, because they face credit constraints, other type of constraints, die, a social loss. So the public policy is a very difficult one to find a sweet spot of supporting what's viable, driven by the motivation of externalities, yet utilizing the private sector capacities to screen and solve the principal agent problems. That's one way to frame it, but when we think about policy, I think we have to think it that way. The second issue, which is Laura's question, I think that in a COVID-type environment, almost by definition, untargeted policies are regressive. So monetary policy and targeted fiscal policy is going to be regressive because it hits the population that has different marginal propensities to consume. And so the poor get whatever they get out of this untargeted policy, and they consume it because they have to live. The non-poor get the money and they gamble because they cannot spend it. And that inflates asset prices beyond what's normal. So I do think we have a very big issue that macro policies in a COVID environment tend to be regressive. And I don't know if we have thought enough about that, but we need to think a little more structured about that.
Great, thank you. Let's say Norman, yes? Go ahead.
Thank you. I agree with the comments that Elías and Augusto have provided, but I would just add in response to Laura, Alejandro, and I think David, who raised issues in regards to the fact that at the beginning of this pandemic, many of the policies were untargeted, and some of them were not very well thought through. And because of this reason, they are having unintended consequences that are very negative. And this applies to all kinds of policies, macro, social protection, and firm support policies. That is true. However, what we see in many developing countries, and I think we are seeing also in developed countries, is that there is a transition of policies taking place, which I find in a more optimistic way. And this transition of policies is from untargeted to targeted for households and firms, from a concern about only liquidity to a concern about solvency of firms, and about any type of stimulus policies to actually policies that have been more tested in the past and that emphasize, in the case of investment, for instance, quality public investment. So I do see this transition, and I think that as time goes on, governments are going to be held more accountable for the policies that they make. In the middle of the crisis, or I should say, when the worst of the pandemic was happening, then governments were almost forgiven to have made these mistakes. At this point of the pandemic, with all the knowledge and information that we have, the governments will have to be more accountable for what they do. And we are beginning to see that process happening.
Great, thank you. Let me ask Professor Hall if he has any other comments.
No, I've checked out. Thanks. Thanks again.
Thank you. Okay, so we have reached the end of our discussion. Thank you very much. I have to make an announcement or a reminder for people, presenters, panelists, and bank staff are being invited to a social hour at 16 hours or Santiago time. You have been given the link. I don't know if Andy Neumeyer, the co-organizer, has any comment or you want to say anything at this point?
I'm fine, thank you.
Okay, then let me thank you again, the speakers, participants, and in particular Sofia, Alvaro, and Andy Niemeyer for helping organizing this wonderful conference. And thanks again.